So heading into 2020, of course, 2022 rather, we have high inflation. We have rates likely going up, perhaps even 3 times. You say one of the best ways to play this environment is high quality names with strong dividends.
Yeah, that's it. And we're really taking our cue from the bond market. If you look at what the bond market is projecting, it's saying we're likely at peak inflation right now, and that will roll over to roughly 2.25%, 2.5% by year end 2022. And growth will likely trend back to its normal level. So I think if you take that backdrop and say, you know what, we're also seeing evidence that this supply chain tightness is loosening up. In fact, inventory growth is outpacing new order growth, suggests that the bond market is probably right. And that is an environment where, just the basic organic growth of earnings and dividends will likely pay the best returns to investors.
And so even with wild cards like Omicron heading into the new year, you think it's still safe to assume that things sort of normalize back to pre-pandemic?
Yeah, I mean, look, Rahel, there are always scenarios out there that we're not going to be able to predict, and so we have to, certainly be aware of that. But part of it is, we think that, if Build Back Better doesn't happen, or if it's scaled back, that will likely also really push these growth rates back to long-term trend pretty quickly.
Okay, what sectors do you like, or what specific names do you like?
Sure. So generally, we like the sectors that have the highest earnings yield, which is really just the reciprocal of the forward PE plus dividends. So that would be financials, healthcare, utilities, and staples. In fact, so J&J is a good example of that. Here's a company that's gotten beaten up pretty much this year because of the performance or relative underperformance of its vaccine relative to Pfizer and Moderna. And yet J&J, certainly a multifaceted company, is projected to grow earnings at 18% next year and have a 2+% dividend, which, by the way, is pretty much been paid consistently throughout history. So very solid dividend, quality company, and strong earnings growth for 2022.
Speaking of earnings growth, I thought it was interesting, and maybe there are some exceptions to the rule that you don't like energy for next year.
Yeah, we don't like energy and materials largely because of the commodity cycle. If you think about it this way, there are really 3 sources of input to production, right? There's capital, there's labor, and then there's commodities. And it's generally a zero-sum game between the 3. So what we've had is very cheap capital has allowed labor wages to rise and commodity prices to expand. But now with the Fed, really throttling back growth with higher real rates and restrained financial, costlier capital, that will likely restrain some wage growth, which we think will obviously go along with inflation, but will also push commodity prices lower. So longer term, we're still energy optimistic, but we think that it's going to have a rough go over the next 12 months or so.